ExamPrep.School. Wyoming Credit Insurance Producer Exam, exam code 12-WY-30 or OP-WY-30. There are 5 practice exams in the series. This video covers Practice Exam 1. The first 20 questions are free. In this video, we will be covering the following major categories for Practice Exam 1. Contracts. Credit insurance. Insurance terms and concepts. Wyoming laws, rules, and regulations. Let's walk through the format. I'll read each question and its choices. Let's get started. Question 1. Under standard credit life policy provisions, to whom are death benefits payable? A. The borrower's estate. B. The creditor. C. An appointed trustee. D. The insurer. A countdown circle appears in the top right. Once it completes, the answer is revealed. You can pause at any time if you'd like longer to think. If you'd like additional practice covering more topics, see the description for our book. The correct answer is B. The correct answer is that credit life benefits are payable to the creditor, as the insurance is designed to reduce or extinguish the outstanding loan balance upon the insured's death. Reason A is not correct. Credit life proceeds do not pass to the borrower's estate, but directly to the creditor to satisfy the debt. Reason C is not correct. No trust arrangement is involved. Benefits are paid to the creditor rather than to a trustee. Reason D is not correct. The insurer's role is to pay the benefit, not to retain the proceeds itself. Question 2. What is the maximum allowable term for a consumer credit life policy under national model regulations? A. 10 years. B. 15 years. C. 20 years. D. 25 years. The correct answer is B. The correct answer is that consumer credit life coverage may not exceed 15 years in term, in accordance with Model Act provisions limiting the maximum loan repayment period eligible for coverage. Reason A is not correct. A 10-year cap is too restrictive. Model rules permit up to 15 years for consumer credit life. Reason C is not correct. A 20-year term exceeds the model regulation maximum of 15 years for consumer credit life. Reason D is not correct. A 25-year term is well above the regulatory limit of 15 years. Question 3. When a borrower repays the loan early, which formula calculates the refund under the pro rata refund method for a credit life policy? A. Unused months divided by original loan months, multiplied by gross premium. B. Unpaid principal balance divided by original principal balance, multiplied by gross premium. C. Unearned days divided by total days in term, multiplied by net premium. D. Outstanding balance divided by monthly payment, multiplied by rate. The correct answer is B. The correct answer is that the refund equals the ratio of the unpaid principal balance to the original balance multiplied by the gross premium, reflecting the unutilized portion of the loan principal. Reason A is not correct. This ratio uses unused months rather than unpaid principal and thus misstates the pro rata refund basis. Reason C is not correct. The net premium and day count method apply in other refund methods, not the gross premium formula. Reason D is not correct. This expression mixes payment counts with rate and does not align with refund calculations. Question 4. Regarding underwriting criteria for joint credit life policies, which requirement applies? A. Use only the primary borrower's health status. B. Assess each applicant's age and health separately. C. Combine both ages into an average age factor. D. Underwrite based on the oldest age only. The correct answer is B. The correct answer is that joint credit life requires separate evaluation of each applicant's age and health, ensuring each risk is assessed on its own merits. Reason A is not correct. Relying solely on the primary borrower's health omits evaluation of the co-borrower's risk. Reason C is not correct. An average age factor is not permitted. Each applicant must be individually underwritten. Reason D is not correct. Using only the oldest age ignores the younger applicant's risk profile. Question 5. In an open-end credit life policy, premium is calculated based on which balance measurement? A. Original loan principal. B. Average daily balance. C. Balance at policy issue date. D. Highest monthly balance. The correct answer is B. The correct answer is that open-end credit life premiums are computed by applying the rate to the average daily balance throughout the policy period. Reason A is not correct. Using original principal ignores fluctuations in balance over time. Reason C is not correct. Balance at issue date does not account for subsequent repayments. Reason D is not correct. Highest monthly balance overstates risk and is not used. Question 6. What is the maximum entry age for coverage under a credit disability insurance policy per model regulations? A. 55 years. B. 60 years. C. 65 years. D. 70 years. The correct answer is B. The correct answer is that model credit disability regulations generally set the maximum entry age at 60, after which new policies cannot be issued. Reason A is not correct. A 55-year cap is lower than the standard model limit of 60. Reason C is not correct. Age 65 exceeds the maximum entry age allowed by model regulations. Reason D is not correct. Model regulations do not permit entry at age 70, which is too high. Question 7. A borrower becomes totally disabled on March 1st under a credit disability plan that has a 30-day waiting period before benefits begin. On which date will the first weekly indemnity payment be due? A. March 30th. B. March 31st. C. March 15th. D. April 1st. The correct answer is A. The waiting period begins on the date of disability and runs for 30 days. Benefits commence on the 30th day after disability onset. Reason B is not correct. A 30-day waiting period from March 1st ends on March 30th, not March 31st. Reason C is not correct. Policies do not pay during the waiting period, and benefits never start before it ends. Reason D is not correct. Benefits begin on the last day of the waiting period, not the first day after it. Question 8. Under a credit disability policy, a borrower's scheduled monthly loan payment is $200, but the policy's monthly indemnity maximum is capped at $120. If total disability continues, what monthly benefit will the insurer pay? A. $200. B. $120. C. $150. D. $180. The correct answer is B. The insurer pays the lesser of the scheduled payment or the policy's stated maximum, so $120 is payable each month. Reason A is not correct. The policy limit, not the loan payment, controls the maximum benefit. Reason C is not correct. There is no $150 provision. Payment is strictly limited to the stated maximum. Reason D is not correct. Benefits cannot exceed the maximum cap regardless of the scheduled payment amount. Question 9. A borrower reviews two credit life options. Plan X has a decreasing death benefit with a fixed premium, while Plan Y's premium decreases as the outstanding balance declines. Which statement correctly distinguishes gross versus net decreasing credit life? A. Gross decreasing has declining premiums. Net decreasing has level premiums. B. Gross decreasing calculates benefit on original principal. Net decreasing on remaining balance. C. Net decreasing keeps benefit level. Gross decreasing reduces premium over time. D. Gross decreasing features level premiums. Net. Decreasing features decreasing premiums. The correct answer is D. Gross decreasing maintains level premiums with a decreasing death benefit. Net decreasing adjusts premiums downward as the insured's indebtedness declines. Reason A is not correct. That reverses their premium patterns. Gross maintains level premiums. Reason B is not correct. Both plans base benefits on outstanding balance. Premium treatment differs. Reason C is not correct. Neither plan keeps the death benefit level. Both have decreasing benefits. Question 10. A credit life policy excludes pre-existing conditions for 6 months. If the insured dies of a condition diagnosed 4 months after coverage start, what will the insurer pay? A. Full death benefit. B. Return of premiums paid. C. Pro rata portion of benefit. D. No payment and no refund. The correct answer is B. Deaths arising from pre-existing conditions during the exclusion period entitle beneficiaries only to a refund of premiums paid, with no benefit paid. Reason A is not correct. Full benefit is barred for excluded conditions within the time frame. Reason C is not correct. Prorated benefits are not provided under the exclusion only. A refund is due. Reason D is not correct. Insurers must refund premiums even when benefits are excluded for pre-existing causes. Question 11. Under Wyoming statutes, which definition accurately describes credit property insurance? A. Insurance indemnifying a lender for loss or damage to property securing a loan. B. Coverage reimbursing borrowers for damage to personal assets used as collateral. C. Policy protecting lenders against borrowers' inability to make payments. D. Insurance covering borrowers for economic loss due to collateral depreciation. The correct answer is A. The correct answer defines credit property insurance as indemnifying the creditor for loss or damage to collateral securing a credit transaction under Wyoming law. Reason B is not correct. That choice focuses on reimbursing the borrower rather than indemnifying the lender. Reason C is not correct. That describes credit life or disability coverage, not collateral protection. Reason D is not correct. That emphasizes depreciation rather than direct indemnification for loss or damage. Question 12. Which peril is explicitly covered under a single interest creditor property policy in Wyoming? A. Mechanical breakdown of equipment securing a loan. B. Theft of collateral used to secure a credit obligation. C. Wear and tear from normal use of pledged property. D. Depreciation in market value of collateral over time. The correct answer is B. The correct answer is theft, as single interest creditor property policies cover loss of collateral due to theft under Wyoming regulations. Reason A is not correct. Mechanical breakdown is an excluded cause since coverage is limited to external perils. Reason C is not correct. Wear and tear is excluded because policies cover sudden, accidental loss, not gradual deterioration. Reason D is not correct. Depreciation in value is not covered, as coverage protects against physical loss or damage. Question 13. What primary benefit distinguishes dual interest credit property coverage? A. It ensures only the creditor's financial stake in collateral security. B. It provides coverage solely for the borrower's equity interest. C. It protects both the lender's and borrower's economic interest in collateral. D. It extends loan maturity when physical damage to collateral occurs. The correct answer is C. The correct answer describes dual interest coverage, which indemnifies both creditor and debtor for loss to collateral under Wyoming provisions. Reason A is not correct. That describes single interest coverage focused on creditor loss only. Reason B is not correct. That applies to debtor-only policies, not dual interest coverage. Reason D is not correct. Extension of loan maturity is not a coverage benefit, but a credit term issue. Question 14. Under Wyoming law, what is the maximum allowable claim limit per item for credit property insurance? A. $25,000 per secured item. B. $50,000 per secured item. C. $100,000 per secured item. D. $150,000 per secured item. The correct answer is C. The correct answer reflects the statutory maximum claim limit of $100,000 per item under Wyoming credit property insurance regulations. Reason A is not correct. That amount is below the minimum thresholds and not the regulated maximum. Reason B is not correct. That represents a common policy amount, but is below the statutory maximum. Reason D is not correct. That exceeds the statutory limit for any single item. Question 15. After a borrower fails to maintain hazard insurance, a lender obtains creditor-placed property coverage with a $1,000 deductible, even though the borrower's existing policy had a $500 deductible. Under Wyoming law, which requirement applies to the deductible on creditor-placed property insurance? A. It may not exceed the deductible under the borrower's original policy. B. It must be at least 1% of the outstanding loan balance. C. No deductible may be applied. D. It may not exceed 2% of the collateral's value. The correct answer is A. The deductible on creditor-placed property insurance may not exceed the deductible in the borrower's original hazard policy, ensuring the borrower faces no greater out-of-pocket loss under forced-placed coverage. Reason B is not correct. 1% of the loan balance is not a statutory requirement for deductible amounts in creditor-placed coverage. Reason C is not correct. Wyoming law does allow deductibles. It only restricts their maximum relative to the original policy. Reason D is not correct. No statutory provision ties the deductible to a percentage of collateral value in forced-placed coverage. Question 16. A borrower's lakeside cabin experiences wind damage, and the creditor-placed insurer proposes to settle based on stated amount coverage. Under standard credit property insurance provisions, which valuation method should be used to determine the settlement amount? A. Actual cash value at the time of loss, applying depreciation. B. Replacement cost without deduction for depreciation. C. Agreed value shown in the loan agreement. D. Functional replacement cost less an amount for wear. The correct answer is A. Credit property insurance typically defaults to actual cash value, which includes depreciation at the time of loss, unless a higher basis is specified in the underlying loan contract. Reason B is not correct. Replacement cost without depreciation applies only if explicitly provided by the loan agreement. Reason C is not correct. Agreed value is not a standard valuation method for credit-placed property coverage. Reason D is not correct. Functional replacement cost may be used in some policies but is not the default method under credit property provisions. Question 17. A hailstorm damages the roof of a borrower's warehouse covered by a lender-placed policy. The insurer denies the claim, stating that gradual deterioration over several years is not covered. Under credit property insurance exclusions, why was this claim denied? A. Wear and tear is excluded. B. Mechanical breakdown is excluded. C. Atmospheric moisture is excluded. D. Collapse from hidden decay is excluded. The correct answer is A. Credit property policies exclude losses caused by wear and tear or gradual deterioration, so damage accumulated over time does not qualify for coverage. Reason B is not correct. Mechanical breakdown exclusion applies to equipment failure, not gradual roof deterioration. Reason C is not correct. Atmospheric moisture covers mold and fungus, not long-term structural wear. Reason D is not correct. Collapse from hidden decay pertains to sudden structural failure, unlike gradual deterioration. Question 18. A lender sends notice to a borrower that it will purchase creditor-placed property insurance unless proof of hazard coverage is provided within 15 days. The notice fails to mention the borrower's right to secure their own policy. Under Wyoming requirements for creditor-placed coverage disclosures, which statement must the lender include in such a notice? A. Borrowers may procure hazard insurance from any licensed insurer of their choice. B. Premiums will be added to the loan balance immediately. C. Coverage becomes effective on the notice mailing date. D. The lender may cancel the loan if coverage is not provided. The correct answer is A. Wyoming law requires that notices for forced-placed insurance inform borrowers of their right to obtain hazard coverage from any licensed insurer, ensuring borrowers have an opportunity to maintain their own policy. Reason B is not correct. Notice must disclose borrower rights, not timing for premium billing. Reason C is not correct. Effective date information is secondary to required disclosure of rights. Reason D is not correct. Lenders cannot threaten loan cancellation in a forced-placed insurance notice. Question 19. Under Wyoming Statute Section 26-34-104, if a credit insurance policy is canceled or terminated, within how many days must any unearned premium refund be paid or credited? A. Within 60 days after termination. B. Within 30 days after termination. C. Within 45 days after cancellation notice. D. Within 90 days after policy effective date. The correct answer is B. Wyoming Statute Section 26-34-104 requires insurers to pay or credit any unearned premium within 30 days after cancellation or termination of a credit insurance policy, ensuring timely refund to the debtor. Reason A is not correct. 60 days exceeds the 30-day requirement specified in the statute. Reason C is not correct. 45 days is longer than the 30-day maximum set by the statute. Reason D is not correct. 90 days is not permitted under the statute's refund timeframe. Question 20. Under Wyoming law governing credit insurance group master policies, what is the minimum grace period length required between a premium due date and policy lapse? A. 15 days. B. 45 days. C. 30 days. D. 60 days. The correct answer is C. Wyoming regulations mandate that a group master policy for credit insurance provide at least a 30-day grace period after the premium due date before policy lapse, ensuring debtors have adequate time to make payment. Reason A is not correct. 15 days is shorter than the 30-day minimum required under state law. Reason B is not correct. 45 days exceeds the statutory minimum, but is not the required threshold. Express authority. Enjoyed this practice test? Tap like, hit subscribe, and share it with a classmate. Got a question we should tweak? Comment below, we read them all. Find full practice exam books in the description or at ExamPrep.School.